IAS 16, Part 2. In Part 1, the asset went on the books at cost and depreciated year by year. Now we go further. The asset can be revalued upward, it eventually gets sold, and it all lands on the financial statements. Let's dive back in. So far, we've held the asset at cost, less depreciation. But IAS 16 offers a bolder route, one where an asset can actually go up in value. That's the revaluation model. Part 3, when assets are revalued and where the gains and losses land. After recognition, you pick a model for each class of asset. The cost model, carry it at cost, less depreciation, less any impairment, simple, and what most use for machines. Or the revaluation model, carry it at fair value, today's market value, less later depreciation. Popular for land and buildings, which can rise. Choose it for a class and you must keep it up to date. And revalue the whole class, not just the winners. Meridian owns its factory building, cost $1 million, carried at $800,000 after depreciation. A valuer says it's now worth $950,000. That's a $150,000 gain. But here's the key. A revaluation gain usually does not touch profit. It goes to other comprehensive income and sits in a revaluation surplus inside equity. Why? It's unrealized. You haven't sold, so it's kept out of profit, parked in reserves. Now the mirror. Next year, the building falls to $880,000, a $70,000 drop. A revaluation loss first eats back any surplus you built in other comprehensive income. No profit hit. Only once that cushion is gone does the loss fall into profit and loss. Gains up through reserves. Losses claw back through reserves first, then bite profit. That asymmetry is the bit exam sitters and analysts both misread. Quick plain English check. Other comprehensive income, OCI, is just a holding area for gains not yet earned through trading, kept out of profit so profit isn't flattered by paper value. A revaluation surplus is the running total of those parked property gains, sitting in equity until the asset is sold or retired. Cost or revaluation, the asset keeps living, you fix it, upgrade it, and one day let it go. So let's handle the repairs, the replacements, and the moment you finally sell. Part 4, repairs, write-downs, and the day you sell. Spend money on an asset you already own. Does it go on the balance sheet or straight to expense? The test is the same recognition rule. Day-to-day repairs and servicing, a €5,000 maintenance, bring no new benefit, so they're expensed. But replacing a major part, a new cutting head, adds future benefit, so you capitalize the new part and derecognize the old one's remaining book value. Major inspections that let the asset keep running get capitalized too. A quick word on the interpretations behind IAS 16. Most are now folded right into the standard. IFRIC 1 handles a change in your decommissioning estimate. If the restoration cost shifts, you adjust the asset. SIC 23 put major inspection and overhaul costs into the asset, exactly as we just saw. IFRIC 20 covers stripping costs once a surface mine is producing. And SIC 14, compensation when an asset is impaired or lost. One standard, the fine print built in. There's also a floor. If an asset's carrying amount climbs above what it could actually earn or fetch, its recoverable amount, it's impaired and written down immediately. The full mechanics live in a neighbor standard, IAS 36, a future episode, but IAS 16 hands off to it here. Depreciation spreads cost. Impairment catches a sudden fall. Now, the moment you asked about disposal, Meridian sells the machine after 5 years for €280,000. Step 1, Its carrying amount. 5 years of straight line at 45,000 is 225,000 of depreciation. So 470,000 minus 225,000 leaves a book value of 245,000. Step 2, the gain. 280,000 received minus 245,000 book value, a 35,000 gain. The journal. Debit cash 280,000, debit accumulated depreciation 225,000, credit the asset 470,000, and credit a gain on disposal of 35,000. And here's the trap that catches even seasoned people. That 35,000 gain is not revenue. Selling a machine isn't Meridian's business. It makes products, not machines. So the gain sits as other income, not sales. Recognize it in profit, yes, but never as turnover. Let's line up the whole life of the asset in journal entries, the debit credit arc. Day 1, you buy it. Debit property, plant, and equipment 470,000, credit cash. Each year you depreciate. Debit depreciation expense 45,000. Credit accumulated depreciation. Revalue the building up. Debit the asset 150,000. Credit the revaluation surplus in equity. And finally, disposal. Debit cash and the accumulated depreciation. Credit the asset and the gain. Buy, depreciate, revalue, dispose. 4 entries, the entire life cycle. We've recognized it, measured it, depreciated it, revalued it, and disposed of it. The last job is to show it, cleanly, so anyone reading the account sees exactly what happened. Part 5, where it all lands on the statements and what investors read. So where does IAS 16 actually appear? The net book value of every asset sits in non-current assets on the balance sheet. The year's depreciation and any impairment hit the income statement. And under the new IFRS 18, they land in the operating category, the heart of the results. Revaluation gains show in other comprehensive income. Recognize, measure, and now present. So what actually lands on your desk at year end? 4 jobs. 1, review each asset's useful life, residual value and method. If they've changed, adjust going forward. 2, scan for impairment indicators, and if any bite, test under IAS 36. 3, if you use the revaluation model, refresh your fair values so they stay current. 4, build the reconciliation note that ties opening to closing. Do those 4, and your property, plant, and equipment is year-end ready. Then disclose. For each class, IAS 16 wants a reconciliation, a story of the year, opening balance, plus additions, minus disposals, plus or minus revaluations, minus depreciation, to the closing balance. Add the measurement basis, useful lives or rates, and the methods. This note is where an analyst reads how hard a company is investing and how fast its assets are aging. And IAS 16 never stands alone. It's the anchor of the asset family. No physical substance, IAS 38. Held to sell, IAS 2. Held to rent or for gain, IAS 40. A sudden value fall, IAS 36. The dismantling promise, IAS 37. Leased in, IFRS 16, and a few threads we've deliberately parked for their own future episodes. Borrowing costs under IAS 23. The full impairment mechanics of IAS 36, and government grants under IAS 20. Learn IAS 16, well in half the asset side of the balance sheet opens up. What do investors actually do with this? 4 moves. They watch capital expenditure. Is the company renewing its assets or running them into the ground? They probe the depreciation policy. Long lives flatter today's profit. They check whether assets are revalued or held at old cost. And they eye asset age, accumulated depreciation against cost, to guess the next big spend. Let's land it all on Meridian's own accounts. The balance sheet, the machine and building in non-current assets at net book value. The income statement, the year's depreciation as an operating cost, and, in the year of sale, the $35,000 gain as other income. Other comprehensive income, the $150,000 revaluation surplus on the building. Every number we built, now sitting exactly where a reader expects it. 4 things to carry out. Recognize, probable benefit, reliable cost. Measure, at full cost, then cost or revaluation, less depreciation over useful life by components. Present, net book value on the balance sheet, depreciation and operating profit, revaluation and other comprehensive income. Disclose, the reconciliation that tells the year's story. That's IAS 16. So, same machine, 2 profits explained. You now know what an asset costs, why the method shapes profit, how revaluation works, and what happens when you sell. Next, IAS 38, intangibles. See you there.